The text of this bill will look different than other bills I have discussed in the past. This text display is due to the immense length of this bill. I had to find a way to reformat the text to better fit with a video format. This is a work in progress. If you have any comments, suggestions, or concerns, please let me know. A bill titled Public Banking Act of 2023 was introduced by Michigan Representative Rashida Tlaib on December 13, 2023. As a disclaimer, there will not be a follow-up video made. I recognize that bills can change as they progress through Congress and compromises are made. If you are interested in watching the progress of this bill, I recommend you create an account on congress.gov and set alerts for this bill, as you desire. Hopefully, this video will give you a foundation to start learning on your own, as is intended. Thank you, and please leave a comment with other bills you wish to see on this channel as well as your thoughts on this bill. Public discussion is important to finding a solution. There are 11 defined terms at the start of the bill, some of which are intended to shorten the total text by replacing the full name with a shorter name. For instance, the Securities and Exchange Commission is called simply the Commission in the text. Some of the other definitions are meant to describe certain associations, like tribal community or state, for easier reference later in the document. If these get confusing in the document, I recommend reading the text with the definitions close by and replacing the shorthand with the full text name. For example, the Board of Governors really means the Board of Governors of the Federal Reserve System. This helps know who is being talked about at all times. The bill uses a new term to me, copyleft. Its counterpart, copyright, means ownership of intellectual property, usually something that is non-physical like a book or computer code, that is owned and distributed under the sole discretion of the originator. Copyleft still recognizes the original owner, but the people the owner gives the right of use to, can do pretty much anything with it, except claim it as their own and sell it as their own. The ability to distribute this license is still up to the copyright owner. The bill talks about covered banks and gives the definition of 3 types. In summary, a public lending bank is any person, yes, person, since most corporations are seen as people, with certain rights, owned by the state, a tribal entity, a non-profit organization of a state or tribal entity, or a combination of all 3. The public lending bank cannot be owned by, or own, any for-profit entity, cannot have any employee or board member that earns more than the U.S. President, and perform a multitude of normal banking services as provided in Section 101, Paragraph B, Subparagraph 3 of this bill. A public payment bank is almost exactly the same as a public lending bank, except they do not provide securities-related services or lending services approved by the Board of Governors of the Federal Reserve System. This roughly means they don't help to buy and sell investments, like stock, or make loan transactions like letters of credit. A non-federally chartered bank is owned by the same entities as the other 2 types, but also meet one of the 2 following criteria. 1. Have approval from a non-federal financial regulator. A list is approved by the Board of Governors of the Federal Reserve System, to be a transactional middleman for large party transactions. 2. Be insured as a deposit institution, meaning you can put money in the bank, by one of those non-federal regulators or directly by the FDIC, Federal Deposit Insurance Corporation, or its approved alternatives. The bill does stipulate that a non-federally chartered bank can be changed into one of the other 2 types if they put in a request with the Board of Governors of the Federal Reserve System. While they are still a non-federally chartered bank, however, they can't accept deposits until they have FDIC insurance, or an equivalent alternative. They must also become a public member bank, or obtain conditional public member bank status while they wait for approval before being allowed to take deposits. A public member bank is just part of the Federal Reserve System and must follow certain regulations. The banks that fall under public member status through the actions of this bill will not be required to buy Federal Reserve Bank stock or put money into the Federal Reserve System as a buy-in. One purpose of a central bank is to stabilize monetary health of whatever areas they cover. They do this through regulations, requirements, and injections into the economic system as needed, to varying results. The Board of Governors of the Federal Reserve System will provide the following services to covered banks as stated in this bill. 1. Fiscal agent accounts, which are accounts that money can be placed into to be managed by the owning institution. For simplicity, you give them money, they give you a return while earning something for themselves. The Federal Reserve System will pay out interest for any money held in these fiscal agent accounts either at the overnight policy target rate plus an additional 2% or the daily interest rate on a 30-year Treasury bond. Whichever is higher. 2. Payment accounts, which are used to transfer money from one party to another. The Federal Reserve will also pay interest on these deposits either at the overnight rate on required reserves, which is the amount a bank must hold based on the amount of deposits from customers, or the overnight rate on excess reserves, which is the amount over the required reserves a bank holds. Whichever is higher. 3. Digital dollar accounts, which is not related to cryptocurrencies. Digital dollars, in this case, is referring to money representations in an account without the need for physical cash or deposits to exist. This happens by putting the physical money with the Federal Reserve and the local bank acting as a pass-through with numbers on a screen. This system requires high regulation, which will be provided by the Board of Governors of the Federal Reserve System. 4. Public Bank Primary Liquidity Facility, to provide liquid cash to public member banks through outright purchasing loans or lending to the bank in order to allow them cash on hand to perform daily operations. These purchases and loans are secured against public loans and securities owned by the bank. These will be purchased or put under loan at face value, which is the price tag of the investment. 5. Public Bank Supplementary Liquidity Facility, to provide liquid cash to public member banks in a similar way, but for assets that are not eligible for the primary liquidity facilities. These assets will be purchased or loaned against at a discount of their value. 6. Public Bank Credit Facility, that provides credit to public member banks in the same way credit cards provide credit to individuals. They are unsecured, meaning they are taking it on faith that the banks will pay them back. The Board of Governors of the Federal Reserve System will determine the interest rate. 7. Federally Recognized Public Loan Facility, that will work with the FDIC to develop rules on different types of loans and lending products from public member banks and make pre-purchase agreements that detail loan purchases between the federally recognized public loan facility and the public member bank. These loans are to be repurchased by the bank later. All of these facilities and services are paid for by the Board of Governors of the Federal Reserve System. They are also responsible for reimbursing public member banks used as pass-through accounts. All expenses from the first three services will be recorded, from an accounting perspective, in an account titled Special Public Member Bank Services Account. It will be counted as a deferred asset, which are assets that are offset from when they were procured or earned. This account is specifically to be separated from other financial statements of the Federal Reserve System so as not to, quote, reduce or impact the calculation of total income or revenue generated by the Federal Reserve System, or otherwise reduce the total amount of net operating profits to be made available for remittance to the Treasury on an ongoing basis, end quote. Section 11.96 of the Financial Accounting Manual for Federal Reserve Banks states that excess funds of the reserve banks are transferred to the Treasury through the Board of Governors of the Federal Reserve System. These transfers are the remittances just spoken of. Deferred assets, also stated in this section, are periodically reviewed for weakness and inaccurate accounting. All expenses from the facilities required will be recorded in a similar manner as the services, except in an account called Special Public Member Bank Liquidity and Credit Account. Covered banks will be required to define, in their own words, what public good and promote the general welfare really mean in their own governing documents. These will be approved by the bank's own governing assembly, if they have one, or the Board of Governors of the Federal Reserve System if they don't. Covered banks have 2 years to develop a governing policy. They must also, not in the same time frame, create a structure for governing the bank. They must have a board of directors that will ensure the bank performs and adheres to all regulations. This board must have at least 5 members. 1/3 of them will represent nonprofit organizations, and at least one member from each of the following: 1 will represent marginalized groups, 1 will represent environmental justice groups, 1 will represent a community development organization, and 1 will represent a labor organization, all from within the covered bank's area of operations. If it is a tribal covered bank, some number of representatives from an indigenous community equal to the percentage of indigenous population will be on the board. The governing assemblies have several responsibilities when established at a covered bank, including employment selection for upper management, monitoring performance and investment decisions, producing reports, and dealing with the government agencies. The same responsibilities are held against a covered bank without a governing assembly, but they must also set core policies and issue their own public reports. Large banks have more regulations. A bank is considered large, in this bill, if it has more than $500 million in total assets. These large banks will be charged to set policies on loans and financing for plans spanning many years. Refrain from interfering with daily operations while still setting policies, have a governing assembly that is professional and gets outside opinions on issues, selects members of the governing assembly through a lottery with experienced pools of people to choose from, and rotate these members at least every 6 months. The People's Review Board also has extra rules. They ensure all viewpoints of affected groups are included in the governing assembly decision-making process, have their meetings open to the public for viewing, also be selected by lottery of experienced candidates, and selected members receive special training and education of bank regulations. Tribal banks give indigenous communities priority of lending decisions. For all covered banks, within the 2-year window, they must create an environmental plan and policy. These covered banks must still adhere to disclosure laws described in United States Code Title 15, Sections 6801 through 6809. Covered banks are also required, if it is possible, to use open-source technologies, which means applications and programs that the user, the bank and their auditors, are allowed to modify, redistribute, and copy through manipulation of the source code. They must also use those copyleft licenses on any programs they develop themselves, as well as provide any software they create to other covered banks for free. Covered banks are still required to keep customer information private. This includes data the bank has acquired. There are limited entities that a covered bank can share their data with: consumer reporting agencies, government agencies at all levels above state, and any search warrant or subpoena authority for legal actions. Even the information about the data, like average customer account balances, this type of data is called metadata, is subject to privacy laws. Covered banks have 1 year to establish lending policies and must update said policies at least every 5 years. At each of these establishing and updating points, the bank must provide a public comment period of at least 90 days. This bill establishes rules on loan preference as well. Projects, whatever reason the loan is being asked for, will get priority if they meet any of the following criteria, assuming the more they have the higher their priority is. 1. Create employment for local workers, especially labor unions and environmental justice communities. 2. Recognize the right of workers to unionize. 3. Implement a project labor agreement, which is basically a preemptive contract for labor and wages. 4. No less than 40% of the loan is for benefits to environmental justice communities. And 5. Quote, meet unmet needs in the local banking market. Unquote. There are also requirements that must be met by the entity asking for the loan. 1. They must agree to unionization if the project involves public funds. 2. If the loan is more than $500,000, all employees of all parties, regardless of where they originate from, are paid, at minimum, wages that are equal to those of the local area for similar work. 3. If the project has a total budget of $35 million or more, all contractors will create a project labor agreement with the following conditions: A. Goals to hire local, lower income, minority workers. B. Report what impacts the project has on underserved communities. C. A plan to incorporate diversity and equity. There are also rules if the project is related to residential buildings, like rental units. 1. The project owner will not be allowed to discriminate against tenants based on standard discrimination factors, sexual orientation, gender. Oddly enough, race is not mentioned, but also other factors like occupation, which it does not specify legality of the occupation, conviction history, immigration status, bankruptcy history, eviction history, and credit score. 2. Must allow tenants to unionize as well, and 3. Will keep the housing price to these tenants at level rates for at least 99 years, including keeping standard annual rate increases to a minimum based on the Consumer Price Index. Covered banks, in regards to regular depositors that are not companies, can't have fees, balance requirements, overdraft or other penalties. The penalties and interest these banks are allowed to impose are very limited. 1. Interest rate on credit will be either A, maximum allowed by the respective state, or B, 15%, whichever is less. 2. Fees cannot exceed the amount from Rule 1. 3. If Rule 1 is broken, the bank cannot collect any more interest on the credit. 4. Someone being charged more can tell the Bureau of Consumer Financial Protection, and if they don't do anything, the person can take it to federal court and get a full refund on interest and fees paid. These banks will give annual reports on nearly every aspect of their operations. Covered banks are restricted from providing loans to companies who support guns, private prisons, immigration detention, and tobacco. Support in this case means to do business with, not the company's philosophy, although that could still be the case. They are also restricted from providing loans to companies that pay their CEO 100 times more than the average worker, has a history of safety and labor violations, and uses offshore accounting and banking to avoid paying taxes. Within 1 year of this bill passing, the Board of Governors of the Federal Reserve System, the Bureau of Consumer Financial Protection, and the FDIC will create an entirely new regulation plan for these banks, and enforce these regulations with public welfare in mind. Covered banks are nearly entirely restricted from providing any assistance to fossil fuel production. This includes providing loans, making investments in, taking compensation from, securing assets for, engaging in any activity with fossil fuel companies and associates. The Board of Governors of the Federal Reserve System and the Securities Exchange Commission are required to establish rules for publicly traded securities from covered banks, and given authority to enforce those rules as they see fit for public welfare purposes. This includes a license to even be allowed to perform securities services. The FDIC is required to establish rules and regulations on deposit insurance within 6 months of the bill passing, including alternative coverages, coverage regardless of deposit amounts, and conditional coverage for banks not yet considered covered banks. Covered banks will also work with the United States Postal Service to implement retail accounts and payment services at the post office facilities, funded by the Board of Governors of the Federal Reserve System. These expenses are recorded in the same manner as the expenses for the services required by the Board of Governors from Section 103 of this bill, and recorded in an account called Special Public Member Bank Services Account. A grant program is to be established to assist banks in becoming public banks by funding all of the changes and services we have mentioned thus far. To be eligible, the Board of Governors of the Federal Reserve System will consider things like community consideration, representation, commitment from community organizations, and will not consider the financial health of the institution. A grant program is to be established that will provide money to covered banks that are coordinating with community development institutions, credit unions, and minority deposit institutions in order to ensure universal access to financial services in underserved communities. All expenses from all of these grant programs will be recorded in the same manner as the expenses for the services required by the Board of Governors from Section 103 of this bill, and recorded in an account called Special Public Bank Development Program. The bill will make changes to United States Code Title 12, Section 4702 to allow state entities to be considered community development financial institutions, which are eligible for grants under the previous section of this bill. Impact 1. Government intervention in markets of all kinds create issues. This goes for banking as well. If it is not well known, a bank is a business that is out to make money, just like a convenience store or manufacturing plant. It even sells products, in this case loans and financing tools/services. The introduction of covered bank, and this little society of banks under federal protection to 2 different points of damage to the nation. Economically, these banks will experience the same issue they did leading up to the Great Depression. Risk management is the responsibility of the financial institutions, as the profession of a loan officer indicates. This allows banks to make loans they are comfortable making while incurring plenty of profit. If they want to, and have the money to back them up, they can take on risky loans and charge high interest rates on that loan, making more money. If they make too many bad choices and lose money, other banks will pick up the slack and bring in more customers who are looking for stable banking and investing services. Just like any other business, if they fail, more customers will demand other products from other businesses, stabilizing the economy, as a whole, naturally. With safety nets like the FDIC, central bank intervention, and required maximums for interest rates, all of which are included and amplified in this bill, the banks will make more risky loans than they would normally for efficient operations. 2008 and the housing market crisis is also a prime example of this lending issue. The second damage point is social. When required numbers of diversity and inclusion are implemented, especially surrounding loans, inequalities are only highlighted, not cured. Decisions of individuals who are better suited for things like employment of financial assistance, those who are truly qualified or in need, are left behind. This type of selective assistance creates more disparity by perpetuating the idea there is a gap when there is not one, and missing the gaps that are really in effect. Impact 2. Maximum interest rates for these loans that all but guaranteed reduce the amount of profit the bank can generate without reducing the risks they will be taking on. Coupled with almost required loans to more risky individuals and businesses, the risk of collapse increases with every passing loan application. This will also increase the cost of other financial services to customers, like financial consulting, or the benefits we get from being customers of the banks, like interest earned on bank accounts or low-risk investments like CDs. With less available and less useful loans, businesses that will further both the economy and the human living standards will miss out on the financial opportunities needed to start off or make big changes. Impact 3. The use of deferred assets with some of these accounts offers opportunity for some hidden asset management that will misrepresent the standing of these banks. With this, investors will not be able to make as informed of a decision when spending their money on the success, or failure, of a business. Poor investing on a mass scale leads to issues like the Great Depression. Since resources are so misallocated, the market is not able to readjust naturally. Impact 4. Without going too in-depth into the issues with unions and labor organizations, labor unions create inflationary issues by demanding more wage increases for large groups of workers without any increases in production output for the company. These wage increases reduce the profit the company has, forcing either an increase in price or a decrease in production quality, quantity, or expansion. Labor unions do have the capacity to develop proper safety and wellness impacts on workers, so they are not without their good uses. Giving companies that implement them preference with financial services provides that same competitive inequality that disrupts the natural order of a market, keeping it from working as it should. The same goes for restricting the availability of services to companies of certain types, like the fossil fuel industries. Yes, green initiatives are important to the sustainment of our planet. But at the expense of efficiently using our resources, these alternatives cause more harm than good. Providing less incentive to make these initiatives more efficient will leave us worse off from a standard of living while also making us less productive. Impact 5. The programs spoken of in this bill are not inherently evil. They aim to do good, and these are considerations that should be held when analyzing these types of changes to our nation. It is important that banks do not fail overnight. The economy will heal itself, but not in one day. Inflation can also be a good thing with increasing populations to support it. A healthy inflation rate is hard to maintain, and programs like the grants and insurance requirements do help create an inflation rate that is quite stable. As long as they are monitored very closely and not overreaching into areas they should not, they can do some good, even if it is only the short term. Please let me know what you think in the comments. Thank you for watching.